Looking at the Markets with David Modell.
Welcome to Looking at the Markets with David Modell. Today I've got a repeat guest. His name is Mr. Brennan Nykreim. Did I say it right?
Yep, you got it.
Oh, wow. Okay. Once in a while I get it right. Mr. Brennan Nykreim is an author and as well as an investor. And he is a frequent tweeter on StockTwits and Twitter as well. Am I correct?
Just StockTwits.
Just StockTwits. Okay. And I believe the StockTwits handle is BGUD for you.
That's it.
And
Yep.
for your partner in the book authoring, it is Innoware at
Yep.
INNOWARE. And I'll put all that information in the description below this video. But the reason we're here today is to let people know about your second free book. Free. I mean, like no strings attached. Okay.
Yeah.
And I really appreciate your generosity. I know how long it takes to write a book. And the name of the book is, let me make sure I get this right. Oh, you got it right behind you. You can hold it up if you want to. How to invest. There it is. Awesome. How to invest in stock market indexes and become a millionaire in 10 years. That's a pretty good plan. I'd like to be a millionaire in 10 years. By Brennan Nykreim, Innoware, and Pranay Pradeep. All right. So first of all, enough about me. First of all, welcome to Looking at the Markets.
Thank you.
Yeah.
Yes.
And
So we
tell me all about this book. Whoops. Tell me all about the book and what prompted you to write this and to just give it away.
Yeah. All right. So we had an awesome experience writing the last book, Trading Volatility, using the 50-30-20 strategy.
Yeah.
We got tons of great feedback, which motivated us to write another book. People are implementing ideas and they're holding cores and they're getting bigger wins. And I mean, it's been such a great environment to short volatility so far because it just keeps melting and melting away. Some of the other feedback we got was that VIX is really complicated. So for people that were unfamiliar with, maybe the stock market or shorting or they just didn't feel comfortable with the VIX. Like, what if it goes up 900%? They wanted something that was maybe a little bit more mild. So yeah. I was sitting with Innoware, and we were kind of somehow, some way, Warren Buffett came up in conversation. And so when he basically passes away and his wife inherits his wealth, he instructed her to put 90% of it into a low-cost index fund. And that is pretty good advice, actually, because as he likes to point out, a lot of people don't beat like the market indexes. Like there's that saying 90% of traders lose 90% of their money in the first 90 days, which is really unfortunate because a lot of people, if they hung in there, I think would get it and then they'd start making money. But if you're out of money, then you're kind of out of the game and things might not go anywhere for you.
Yeah.
So we started to talk more about like the indexes. And one of the things is just kind of like UVXY, it's usually safe to assume that thing is going down in a bull market. It might have some spikes, you might get some volatility, but it mean reverts and, kind of continues its path downward. So, like, I've got a 100-year chart here for a visual of the Dow Jones, and
cool.
You can see, there's been some drops, there's been some hard times.
Yeah.
But in general, the market continues to expand and grow, and so typically, if you're in it for enough time, the edge is that it's going to continue to expand, which
Sure.
is awesome because you sort of have some sort of directional edge.
Gotcha.
So we figured we'd sit down and we'd look at the different tickers from non-leveraged to leveraged and see, could we become a millionaire if we started investing in these? So we ended up looking at 14 different tickers, and I'm going to give another quick visual here.
Sure.
Basically, this is probably my favorite page of the book right here. There is one typo that I crossed out. You can see that the 1X ETFs didn't do all that well.
Right.
The 2X did better and the 3X did better. And I'm going to jump back a little bit more to the strategy and then come back and talk about how the different exchange traded products did.
Sure.
So the strategy is to take $5,000 every year, and you can do it over, maybe you have an automatic deposit of, about $400 every month, or maybe at the start of the year, you throw in $5,000. And we also talk about if you're going to do all the money at once, I think it's a good idea to open up a retirement account, like an IRA, so that you can basically deduct that from your taxes and put it into an account. And if you, at some point close your positions, you don't have to necessarily pay taxes on it. Whereas if you're doing just a couple bucks every month and you're doing a lot of buys over the years, those commissions will add up, especially over 10 years. 10 years, it'll eat into your profits. So we kind of talk about the different accounts depending on, how you're putting the money in. And then we say you can either buy dips or just jump right in. The money's there, just buy in, because these should expand with time.
Got it.
So there were two tickers that really stood out as winners. The first one was TQQQ, which is a triple leveraged ETF, and you would have turned that $50,000 that you would have put in over 10 years into roughly $1.5 million.
Wow.
Which is amazing. Yeah.
Yeah.
The other thing that I should say is that we looked at the compounded annual return, because these ETFs like TQQQ hasn't actually been around for 10 years.
Right.
So we're using past data to, kind of project the future, and who knows, maybe it does better, maybe it does worse. We just basically took an average and did that.
Sure.
And then for fun, we decided to take SVXY and see if we just bought SVXY, which is short volatility, how would that go? And let me see if I can get the exact number for you. The $50,000 would have grown into $2.6 million. And so I think that's pretty incredible. Not to say that, you wouldn't have had some hard times, like Brexit or, 2015. So if you do choose to, play those like leverage products, like the leveraged ETFs, one of the things people should know is that, you want to be on the right side of the market. So if we get into a recession or bear market and you're in a 3 times leveraged bull ETF, it's going to hurt. You're not going to get that. Well, chances are against you from getting that $1.5 million. So it's at that point good to kind of put in some risk management strategies, whether there's, some sort of a trailing stop. So, your ticker's going and your stop's kind of this right here. And then all of a sudden, you get a drop, you stop out, and then you look to buy in lower, sort of a thing. So we the nice thing about it is that the strategy is really simple. And like I said, there's a small edge to it. And we just wanted to kind of answer the question for ourselves, like, can we become, millionaires without working very hard for it per se? Like, coming in and everyday trading can sometimes be stressful, or, you kind of have to cope with the ups and downs of the market, type of thing. And so the strategy is really exciting, and we're basically just trying to help as many people as we can, so that people can make money. And so we're giving the book away for free, and you can also get the ebook. The ebook's also free, and if you would like to buy it, it's also for sale on Amazon for $99. So you can email in. I'm going to hold up the sheet right here.
Let's get that contact info right there, and I'm going to put it on the screen as well as in the description below this video. But it is free copy of Trading Volatility book. The email is info@tradingvolatility.info. Now, if you want a free copy of Investing in Stock Market Indexes, you can email info@indexinvesting.xyz. And if you want both, email either one of those email addresses and let them know that you want both, and they will send it to you. That is so generous. I think that's great. It amazed me when you actually, and this is very few people, but when you become as popular as you have, you're going to get a few haters out there.
Sure.
I don't know what, is it jealousy? I don't know what it is, but you actually had maybe one or two people on StockTwits. I remember criticizing you for giving away a book for free. I can't explain that. Can you wrap your head around that? And what is your response to this?
So thanks so much for asking. So yeah, I think that there is some jealousy because Untitled is posting all of his trades, so you can see, he usually makes a couple $1,000s every day, day trading, swing trading, and I haven't started to post mine yet, but I think that there's some jealousy because I do think that a lot of people either they lose money even if they have an edge, maybe they're over leveraged, or they're not managing risk, or they're frustrated, maybe they need to make that money to pay rent, and then they see someone else that's having success, and I mean, sometimes it's hard not to feel frustrated or why am I not getting this? Why am I not having success? But I'm one of those guys that if there is something difficult, I get kind of excited about it because I think that that's how people grow. So we had kind of a subscription service, and we decided, instead of making people pay for it, let's just send out a free letter. We sat down, we're like, what are our core values here? We're gonna help people for free, and if people want the information, we're gonna send it to them. We're gonna get it to them, and it only kind of made us more excited to help people. So definitely a positive thing.
Absolutely. People should know you're not getting paid to make this video. I'm not getting paid. No one's getting paid here. And I've been reading every single one of your free email newsletters, and it's amazing. You keep coming up with new angles, new ideas, new possibilities, and you're not charging a penny for it. So I think it's great what you're doing. You're giving back to the StockTwits community and the community and now the YouTube community. So I really appreciate this. Just to give a little bit of background info, your first book was Trading Volatility Using the 50-30-20 Strategy. There it is. Yeah. We featured that in another video. I'll put a link in the description. There it is. You can request a free copy of that as well if you want something a little riskier, but maybe more reward. You mentioned investing in SVXY. That is a non-leveraged or single leveraged, either way, reverse or inverse volatility ETF, okay? And you also discuss investing in or shorting UVXY, VXX, TVIX, so on and so forth, all right? And that's a whole different strategy, not for the weak of heart, not for the people who can't stand large drawdowns at times, okay? And so I get the impression, and you can respond to this if you want to, that your second book, How to Invest in Stock Market Indexes and Become a Millionaire in 10 Years, that's maybe for people who don't want to ride such a steep roller coaster. Would that be accurate?
Yeah, I love the word choice of roller coaster because when volatility goes against you, it can really go against you, and that's when it tests your kind of everything you got, from your emotional fortitude to, if you've ever had a position that, is just fighting you, and you wake up every morning and the first thing you do is pull out your phone and you're like, oh, it's down another 10%.
Yeah, I've done that.
I think we've all been there at some point.
Yeah.
You sort of at sometimes will experience some pretty huge drawdowns, and navigating the sort of psychology and the risk management is really tricky, and that as well as basically sizing. There are times where we won't quite go into backwardation, but if you're short UVXY and that thing just goes up, it's definitely difficult because you've got to kind of decide in your head, what are you going to do? Do you believe that this event is going to go away? And are you willing to sit and basically fight it,
Yeah.
And hopefully, once again, you're not oversized, so you can sit on it. Because if you are, it's just a bummer to be stopped out, and those gains that you had, they're gone, and you're like, all that work that I just put into it. So it's definitely this new strategy is very tame. It's very slow, gradual.
Gotcha. And I'm sure people appreciate that. Not everybody wants to watch UVXY all the time, or TVIX or VXX, or learn about all the nuances of that. So this is a way to build wealth over time and not have to watch all the time and not have to worry so much. And so I think it's great what you're doing. Now I just want to talk about some of the chapter titles here. For example, the chapter 12, the 70-30 strategy for the active investor. What is the 70-30 strategy?
It's really for trading. So we kind of put in, we know that some people kind of want something sort of in between trading volatility, and some people want something kind of in between buy and hold. So we recommend, you do have most of your capital invested, and then you take a portion of it and you can do something like options or, try to time the market essentially. We sort of, that chapter has a very small portion in the book because I think that most people, if they're going to commit to the buy and hold strategy, are just kind of better to just go for it, basically. Just buy it, hold it, unless they see that we're about to hit some sort of market crash or recession or something like that. So
okay, fair enough. There's another chapter 16, another title for a chapter, What to Do in a Recession. Boy, I wish I knew. Other than panic and freak out, is there anything you can do?
Yes. So in a recession, we recommend if that's about to happen or happening, that you go to cash, and we give the opportunity to, instead of being in like bull ETFs, even for example the SPY, which is not leveraged, is bullish on the S&P 500 index.
Yeah.
You could go to a bear ETF, which, granted, I mean, those, I always encourage people to do their homework. What's the risk? If we just get a quick dip in the market and then you're like, oh, it's going to crash, and you get in right at the bottom and it goes against you. Yeah. That's hard, but it's sort of, the more that you kind of deviate from buy and hold, the more kind of thinking and thought process that you got to do. So you could look at the VIX futures curve to see if that's a potential time to go long volatility. Are we in backwardation at that point? You could look for bear ETFs, or you could basically go cash and just kind of sit it out. See if you can wait it out. And when you think it's going to recover, that's a great time to basically buy back in and just and take the train right back up.
Gotcha. And people are probably wondering, where the heck do I get this book? It is, you could just go to the website indexinvesting.xyz, not .com, .xyz, all right?
Yeah.
And if you're still interested in the volatility trading book, you can go to tradingvolatility.info because it's still available, still there, all free. Now, you do ask that people enter their email address because you have to know where to send it to. So, you'll just put in your email address and they will send it to you. And also, when they sign up, will they also receive the newsletter? How does that work?
I believe so. Yeah, you can receive the newsletter, and if you want to unsubscribe, that's completely okay. There's an option in there. So totally up to you. It's optional. We're not going to force anybody to do something that they don't want to do.
Got it. Your feelings won't be hurt if somebody unsubscribes. Got it. Okay. You won't take it personally.
Absolutely.
Understood. So another chapter says, why not invest in individual stocks? Stock picking can be very exciting. Ooh, I love Apple. I love Starbucks. I love Amazon. Index investing might seem a little on the boring side to some people, even though becoming a millionaire isn't boring to me. But so why not? Now, people can do whatever they want, but why, in your opinion, do you not invest in individual stocks, at least in this book?
Okay, so the indexes are good because if you buy the SPY per se, it's holding shares of a lot of companies. So it within itself is diversified. If you decide that you want to stock pick, you kind of have some unique risks, such as, I remember back in the day, Steve Jobs came out to do a presentation for Apple, and he looked really sick, and the stock price dropped because people were losing faith that Apple was going to continue on higher. So, you had to watch the stock drop. if you're doing biotechs and you're waiting for FDA approval, and then it turns out the FDA approval didn't come through, or it's going to take 5 more years, and the company has to do toxic financing and dilute their shares. That it's just, those are kind of tough situations. And then even sometimes, think about like market rotations. The tech sector gets a lot of money into it, and then people decide that, I want to leave tech and go into something else. So sectors themselves can sort of struggle, and each kind of company has their own kind of risk factors. Like Deutsche Bank, for example, they get fined kind of out of the blue. And then there's so much bad news that can happen, but typically bad news isn't going to happen to like an ETF. So that's another thing that kind of makes it boring, because it's sort of like stable, it's consistent, whereas you do get some highs and lows. You get good news and bad news with individual names.
Yeah. Again, the roller coasters, the unpredictability, and when you just invest in one stock, things can happen that are beyond anybody's control. Whereas with the S&Ps, you're invested in 500 different stocks. It would take a lot to bring it down 10%, 10, 20, 30%. Yeah, so again, less of a roller coaster ride, easier to ride out the drawdowns. Because my understanding is that if you invest for, let's say, 20 years, no matter what point in time you started investing in the S&P 500, 20 years later, you would at least break even and probably make a gain, even if you invested at the worst possible time. I believe that this is a really great strategy for people who have that kind of time, people who have money that they can set aside and set it and forget it, as they say. Is this truly a set it and forget it strategy in this book, How to Become a Millionaire, investing in stock market indexes to become a millionaire? Is this totally set it and forget it, or how much monitoring is required?
I would consider it a set it and forget it. Like I said, with the exception that if you are playing those triple leveraged ETFs, you really don't want to get caught if the market switches from a bull market to bear market. So granted, you could just set, like I said, a trailing stop, set it and forget it, and that way things are kind of automated, and you don't have to watch it every day. If you're doing something like a single leverage ETF, like I keep using the SPY, for example, that really is a set it and forget it, and you get your dividend, and you just keep doing it, kind of a thing. So SVXY, I think that kind of comes down if you have that kind of personality. I personally would be a little bit more active with SVXY, because it's, in my opinion, riskier. You have the opportunity to make more money, but you're also, that thing could hypothetically go to zero. So imagine yourself, you're on year 9, you've somehow turned that 50,000 into, 1.5 million. And then there's some extreme unthought of black swan event that, takes it all away. So, to each their own. Everyone kind of has to trade their personality. And I believe like the less leverage you're using, the less you'll manage it.
Yeah.
And the more leverage you're using, the more you'll kind of want to keep an eye on it.
Right. Gotcha. So if somebody wanted to replace TQQQ, which is a triple leveraged NASDAQ bull ETF, maybe with just QQQ, which is non-leveraged, could that work as well?
That would totally work. Yeah. And that is something, we have that in the book for something you could do in a recession. Basically leave the, either cut down from a triple leverage to a 2 times leverage, or just, two to non-leveraged kind of idea that we have.
Great. So there's something for almost everybody here who wants a less active, more or less. You can adjust it, is what I'm saying, based on your needs and your financial objectives. And finally, brokers. Why shouldn't everybody just get Robinhood, or should they nowadays? Why pay commissions at all if you don't have to? What are your thoughts on that?
Well, I think that if you're going to be putting money in every month and kind of doing the buy and hold strategy, Robinhood is actually a great solution. Because spending money to basically buy and hold doesn't exactly make sense to me. And I think that Robinhood has shown that it's good enough. They promise to be zero commissions for life. Hopefully they follow through with that.
Okay.
However, let's say that you wanted to do some trading. Let's say you wanted to do some options, or you wanted to do something a little bit more complicated. Like instead of holding the SPY, you wanted to try to do like an E-mini S&P futures. Like Robinhood is very limited for what it can do at that point, and Robinhood doesn't offer like a retirement account. So if you basically if you stop out or decide you want to take some gains, which is totally okay, nothing wrong with that. You're supposed to pay taxes on it.
Sure, understood. And people should know that everything we're saying is subject to change without notice. Neither of us is a licensed or registered financial advisor, so you have to make your own decisions. We cannot advise you on what to do in an IRA or the tax consequences, anything like that. If you decide to get this book and the newsletter, you need to make your own decisions. However, these strategies are about as safe as you can get, I think. I mean, buying and holding for a long period of time with trailing stops or some other hedging mechanism, that's about as good a strategy for buy and hold or modified buy and hold that I can think of, at least right now. So, I'm just very proud of you and what you're doing, and InnoWare and everybody involved in the book. So I just want to wrap it up by saying thank you so much for doing this. I mean, I just knew I had to get this out there. I'm going to promote the heck out of this video. And once again, if people want to get in touch with you and they want to get the book, what is that contact information? One more time, please.
Yeah, got it.
There it is. Right. Free copy of Trading Volatility. The email is info@tradingvolatility.info. If you want to get the investing in stock market indexes to become a millionaire, hopefully, email info@indexinvesting.xyz. If you want both, just go to either email. They'll send it to you. And you could also go to the website, and I'll keep that up on the screen, but it is indexinvesting.xyz. If you don't feel like emailing, you just want to go to the website, enter your email into the box there, and they will send you a copy for free. And if you're interested in something a little riskier, but maybe more reward, go to tradingvolatility.info and put your email in there, and they'll send you that book for volatility product trading as well. And you can also, totally optional, get on the mailing list, and they will send you daily or almost daily emails with lots of ideas. It is so cool. And go to StockTwits, subscribe to these handles, please. At BGUD for Brennan, at InnoWare. Check those on a regular basis. Why the heck not? Did I miss anything? Is there anything you wanted to tell everybody that I missed?
There's one thing. We actually just, even though we finished this book, we got a rough draft of a cryptocurrency book. So I'll be back on your show. Cryptocurrency makes me really excited. So we're going to tie. It's sort of like cryptocurrency 101. How do I buy Bitcoin or what's this Ethereum thing? What's an altcoin? So I hope to be back and share that with everybody. So. Absolutely.
We'll bring you back here for that one, or just for any updates, anything that you just want to tell the people, because I've got a growing channel, and I want everybody who's watching this to just go ahead. What do you have to lose by downloading a free book or two? Okay, so go for it. That's what I say. Mr. Brennan Nykreim, thank you so much for coming on. I appreciate everything you do, and hopefully we'll see you again real soon here on Looking at the Markets.
Thanks, David.
Thank you for watching. Please like, comment, and subscribe. And I'll see you next time.